Welcome to The Explainer. Today, we're digging into a massive, multi-billion-dollar bet that seems to fly in the face of everything we hear about the future of energy. You've got one of the world's most famous investors going all in on big oil, and we're going to break down exactly why. So get this, Warren Buffett's company, Berkshire Hathaway, has been quietly but very deliberately snapping up shares of a major U.S. oil and gas producer called Occidental Petroleum. They now own over 28% of the entire company. We are talking about billions and billions of dollars here.
All right, so let's really get into it. I mean, in a world that is pushing so hard towards green energy, a move like this kind of feels like a step back in time, right? But as you're about to see, there's a really calculated strategy at play here. So what is it about this specific company, Occidental, or Oxy as a lot of people call it, that really caught Buffett's eye? You know, for an investor who is absolutely famous for his discipline and his long-term vision, there has to be something more going on than just, well, oil.
See, Occidental isn't your granddad's oil company. It's got this really unique blend of assets. You've got the reliable, old-school conventional production, the more dynamic U.S. shale operations, and, this is the crucial part, a growing platform in carbon capture technology. For Buffett, this mix is pretty much the perfect recipe. The oil and shale parts, they provide predictable, super strong cash flow right now. But that carbon capture piece, well, that's a strategic bet on the future of energy. It gives him what investors call optionality. So it's really a bet on today and tomorrow. But, you know, Berkshire's approach isn't just about what they bought, it's about how they're doing it. And this right here is where the real genius of the whole strategy starts to come into focus.
They're using this really sophisticated strategy that people are calling a control-adjacent position. Just think of it like this. You get all the perks to being in the driver's seat. You have the influence, you get the inside info, but without all the legal headaches and the massive cost of actually buying the whole car.
Right, so a full takeover gets you total control, sure, but it is slow, it is incredibly expensive, and it gets bogged down in all sorts of regulatory stuff. This other way, this control-adjacent stake, gives Buffett the influence he wants while letting his company stay nimble, save its cash, and keep its future options wide open. It's just a masterclass in financial efficiency.
So, here's the crucial point. When an investor of this stature makes a move on this scale, it sends a powerful signal to everyone else. This isn't just about one company anymore. It's a huge statement about the entire global economy.
It really shows how the world's wealthiest long-term investors, what some people call dynastic capital, you know, wealth that's meant to last for generations, are getting ready for the future. They're positioning their money for a world that could be facing energy scarcity and a lot of geopolitical instability. They're anchoring their wealth in things that people will always need.
You know, in a world full of digital currencies and crazy inflation, the message here is a powerful return to basics. The focus is shifting back to tangible, real economy assets. We're talking about things that are absolutely critical to our lives, that generate predictable cash, and that are expected to hold their value no matter what the economy throws at us.
Okay, so let's quickly recap what we've covered here. First, Buffett's bet isn't just on oil. It's on the durable, long-term cash flow from an essential resource. Second, that control-adjacent strategy is just a brilliant way to get influence without all the baggage of a full takeover. And third, this whole thing is a major signal that the smartest money out there is pivoting to hard, real assets because the future looks, well, uncertain.
And that really leaves us with a final, crucial question to chew on. When an investor who has successfully navigated decades of economic chaos makes such a decisive move back to tangible, essential stuff, should the rest of us see that as a sign of confidence, or maybe as a warning of some serious turbulence to come?